All right, so first part of the mining case is we wanted to go through and score in the arbitrary 1 to 5 scale each one of these numbers. So what I'm going to do is, in the previous classes, they had done this. So in the interest of time, I'm going to post what they told me, see if we agree with this. So again, I'm not claiming this is right or wrong. This is what they told me. The numbers said. So just directionally, we're doing similar numbers.
How come it's only slightly below for the industry when it's 11% versus 8%? With the peers 7% versus 7.9%?
Are you talking about a 2 versus a 1?
Yeah.
Yeah, I wasn't really vetting their actual numbers. As I said, I'm just more interested right now in directionality. So above or below is probably more important than whether it's a 1 or a 2 or 3 or 4 or 5. Obviously, we can define granularly what each of those mean more. All right, but here's the thing. So if we're going to start analyzing, where do we start? What do you think the place, which of these numbers do you think is going to matter more than others? Probably ROIC and to some degree growth. Because remember we talked about, think about key value drivers. It was spread, growth, sustainability. And taking out cost of capital, ROIC, growth, sustainability. So ROIC and growth are two of the more important things to look at. So at a ROIC perspective, basically what we see is for Rio Tinto, they've been underperforming the industry for the last 6 years on average. All right, they've been underperforming BHP, they've been underperforming the industry. So that would be sort of the first thing we'd notice. Second year, in terms of their growth rate, they're also one of the slower growing firms during that period of time. All right, so they're not growing and they have worse than average ROIC. So I didn't have to tell you what their share price is, but you know it's not going to be a good looking share price chart. All right, so let's go a step forward. Two drivers of ROIC: margin, cycle time. Okay, so Rio Tinto, cycle time. Generally, Rio Tinto's cycle times have been a little bit better than the industry over time. About the same or better, right? And about the same as BHP on average. So really, the primary reason why their ROIC is worse, they, unlike AECOM, are a margin story, right? So it's their margins which have been underperforming their peers over time. And that's the way we can start thinking about this business. Now, as we look at the data, see a few trends. One, you can see at the industry level, not only did Rio Tinto see the lowest margins in the industry in 2013, but generally the margins collapsed at all of the firms in 2013 after peaking in 2011. And you can see that the average margin went from 27% down to about 13.5%. So industry margins cut in half. Rio Tinto's margins went down dramatically. At the same time, look at the trend. Margins are going down, while cycle times are getting longer for the industry. Right? The two together are what's really hurting the ROIC. So it's taking longer to get the capital back that they put in place. Part of the reason is they're making bigger capital bets. The other part of the reason, and this is data you don't have in your presentation, but basically the cost to put capital in place to mine a ton of capacity has gone up by about 30%. So it's costing more to build these mines, and they're putting more money into mining in general. The whole industry is doing that. At the same time, prices are coming down, and so it's getting more expensive to earn lower margins. That's the story of early 2014. And whether you do it with or without goodwill, ROICs are plummeting. Okay? And therefore, so are share prices. Now, here's the interesting thing. I can look at the story on a cash flow basis and see an interesting parallel to the ROIC story. that you can see that industry gross cash flow peaked in 2011 at almost $63.25 billion. So these four companies had record profits in 2011. And 2010, 2011 were two really good years. Notice 2 years later, that gross cash flow has fallen to a little under $28 billion. I want you to see the parallel here. Look at all the gross cash flow in 2011. Look at all the gross investment in 2012. Look at the collapse in gross cash flow in 2013. This is the overcapacity that the mining industry is facing today. That what's interesting is each one of these mining companies made a very rational decision, which is when I'm looking at this data in 2011 and I'm making huge amounts of cash and I'm making an ROIC of about 25%, doesn't it make sense to pour that money back in the mining industry? Just intuitively. Keep making 25% and grow that business. And that's what they did. But the problem is they all did it at the same time. And so they all invested a huge amount of capacity in 2011 going to 2012. And you can see that the reinvestment rate spiked to 133.5% of industry profits. So, and Rio Tinto was one of the biggest investors. They spent more than anybody else on mining. Within the first 6 months of 2013, all five of the mining industry CEOs were fired. They all lost their jobs because investors watched the stock prices of all these companies collapse, and they said, how could you not have seen what was going to happen by your over expenditure? Because what happened was it became a supply-demand issue. That the most important of the five forces in the short run is rivalry. The most important part of rivalry is supply and demand. They increased supply almost exponentially. Demand was tepid at best. They're now working off the excess supply by slashing prices. And ROICs and margins are plummeting as a result. And that's what I'm saying. Independently, they all made rational decisions to invest, but collectively, it killed the industry. And now they're working off all of that excess supply. And that's to some degree what BHP was telling you in this article that I put in from the Financial Times that came out about a month ago, which basically said, we're going to divest a lot of the things that we just bought and focus on our core business, and we promise we're not going to overinvest again. And this is a common theme amongst all the new CEOs. So the CEO of Rio Tinto has been saying the same thing. He's basically saying, look, I'm cutting $5 billion worth of expenses. I'm only going to invest in mines that have good paybacks and good returns, and I'm going to force myself to have discipline by paying out giant dividends, what they call a progressive dividend. So it basically means they're taking away money from reinvestment because they're paying it out, because they want to be disciplined so they don't end up in this situation again. And what's interesting is this mining industry has been through this cycle before. This isn't the first time this has happened to a commodity industry. But if we really want to understand how the story is being set up, it comes very clearly into focus with the economic data that we just created. And that's why it's going to be important to do two things. One, continue to put the data into this format, but two, to basically start to figure out that there is story being told and to tell that story. That's what a good analyst can do, is because the decisions lead to the numbers. So by looking at the numbers, we're working backwards to get a better appreciation of the decisions to understand what's really going on in this industry. And this is an industry of overinvestment causing essentially and tepid growth. And the problem is that if you look at the forward growth expectations on this slide, the expected growth next year is expected to be negative in the industry. So I have all this new capacity online. My growth is actually declining, and everybody's trying to figure out a way to sell all this ore, and they're doing it at lower prices. And unfortunately, what's now happening is China's becoming a problem, because China's now starting to say our growth rate may not be as high as we thought, so we have to do something about this. And what they're doing about it is they're making less infrastructure investments in China because they don't want to have excess capacity as well, but it's working its way back to the mining industry where they now have all this ore, and they were hoping that India and China would absorb it, and India's economy is barely growing. China is starting to slow, and they were expecting a lot more expansion in those two economies, and all the miners are suffering for it. Long term, will this sort itself out? Probably. But in the short run, these are the dynamics that this industry is facing. So if we were to do evaluation, then this is the starting point that we have to have the historical perspective so we can start thinking about the future. So that's a little preview of the types of analysis we're going to do out of the statements. Questions about this? Other comments, observations? Sorry, I was a little bit more prescriptive in this just because we're recording this on video for the other classes that didn't get a chance to see this. So here's the deal, as a reminder. So on Wednesday, this class is going to be a lecture which is going to be recorded. Okay, so the first two sections of the day are Bloomberg Labs. So if you want to work in the Bloomberg Lab in advance, you're welcome to come in earlier in the day because that Bloomberg assignment will be posted early on Wednesday morning. The 2 p.m. section, the one right before this, the CSX speaker will be guest speaker. So again, you're welcome to attend that if you want to see that live. Then this section will be a lecture, right? So that's basically the way that Wednesday is going to play out, right? So we'll see everybody on Wednesday.